Hello, welcome to Any Answers Answered for February 2021. This month we are going to start looking forwards again. Hopefully tax returns all now done and behind us. And we're going to look at two questions this month, which the question itself and the answer are relatively straightforward. But Tim and I were both struck by some of the other issues that crop up around these particular topics. Our first question this month relates to self-employed income support, and quite simply the question is whether for loss relief purposes the income is classed as business income in terms of loss relief and that sort of thing. But actually the more interesting question, Tim, perhaps relates to the income for pension purposes as well.
Well, fortunately, there's a very simple answer to this. And as is often the case, what we need to do is see what the legislation actually says. And one of the answers posted to this particular query does indeed look for us at the legislation. And the legislation is in the Finance Act 2020, Schedule 16, and Schedule 16 specifically says that the coronavirus support payments referable to a business will be treated as a receipt of a revenue nature for income tax or corporation tax purposes and is to be brought into account in calculating the profits of that business. And that would include calculating any loss. And HMRC have already published, software developers have seen this, the 2021 tax return for the current tax year. And for self-employed sole traders and partners, there is a separate box on the self-employment or partnership pages for including the SEISS grant. But when it comes to dealing with it for other purposes like loss relief or pension contributions, it will, as the legislation says, be counted as part of the business profit. So we just treat it as trading income. And that means that the question posted falls away. There is no question about how it's dealt with for losses. Is it available for sideways relief, etc. Because the loss will be determined after taking into account that amount. But it also answers the question that one of the correspondents raised about pension contributions, saying quite sensibly, I thought, that from the pension point of view, within the next few weeks, financial advisors need to get cracking. We need clarity on this. Well, here is the clarity. The SEISS grants will be treated as earnings for the purposes of supporting pension contributions, where, of course, the pension contribution within the annual allowance must not exceed the taxpayer's earnings. And the SEISS grants do count as earnings because they will be part of the trading profit, and the trading profits, of course, count as earnings.
An excellent and very simple answer to the question. Our second question, actually, again, funnily enough, it's the points made on accountingWEB that are more interesting than the question itself here in many ways. And so the question from an anonymous business owner, quite simply, they've posed a question as follows. In my first year, he says, in addition to the £10,000 of share capital to keep the business afloat to cover expenses, he's paid directly from his personal bank to pay those business expenses. And the question he's asking here, can he take that money back out again without having to pay PAYE or national insurance? And I think we can say quite quickly, Tim, yes, no problem with that. But some of the answers offered to him on accountingWEB were fascinating.
Well, straight away, the correspondents refer to the £10,000 share capital. One of them says, £10,000 share capital, did you take advice before deciding this? And reading further down, the general impression appears to be that what the individual should have done is put in just £1 of share capital and the whole of it as loan capital, on the basis that you can then take out a repayment of that loan without any tax or NI implications. Here's a later one. Next company, talk to your accountant before issuing that many shares. You only need one share. The point that you and I would make is that actually the way in which you finance a company like this could have adverse tax consequences unless you think very carefully about it at the beginning. Now, the company in this particular question has become profitable. And so we've now got £10,000 of share capital in a profitable company, and it's not going to be possible to take that out of the company in the way that it would be if it had gone in as a loan. It's not impossible because, of course, as you and I know, having done it ourselves with Absolute Accounting Software Limited, we can quite easily arrange for the company to buy back 9,999 of the shares with no tax consequence, apart from reduction of the allowable expenditure for a future disposal. But the reason why I would have suggested that putting in 10,000, here's another one. Wow, £10,000 shares. Let me guess you thought about going on Dragon's Den. Well, you know, this sort of sarcastic comment isn't terribly helpful. If the company had failed, that's the question we've got to ask. What would happen if the company failed? If you put 10,000 in as loan capital and the company fails, you can claim a 10,000 capital loss on the loan, but you can only use that against capital gains. If you put 10,000 in as share capital and the company fails, then the capital loss on the shares could be treated as an income tax loss, and you could then offset it against other income. Now, I imagine that in the current economic circumstances of the pandemic, there may well be quite a number of individuals, employees, who continue to get paid their salary. So they do have 20, 30, 40, 50,000 a year of salary, but maybe they've set up a business on the side. Well, if that's been set up as a limited company, then if you finance it with 10,000 of loan capital and it goes bust, you've got a 10,000 capital loss. If you finance it with 10,000 of share capital and it goes bust, you could set that 10,000 against your 30, 40,000 employment income. So I would question the way in which this particular thread has developed in terms of criticising effectively the shareholder for putting in 10,000 of share capital. I would advise them to do exactly that. Part of the problem is that it used to be far more difficult to arrange a repayment of share capital. And did I say purchase of own shares? I shouldn't have said purchase of own shares, should I? I should have said repayment of share capital. You used to have to get a court order for a repayment of capital, but that changed several years ago. I forget which year, but quite a long time ago. And there are still too many accountants who are thinking back to the old days where, oh no, you shouldn't put in share capital because it's too difficult to get it out again. It's not. Today, it's far more easy than it used to be to get that share capital back out.
Yeah, as I always end up saying on courses, the difference between low shares, high debt and just shares in good times for a business, it's all fairly neutral. It doesn't really make that much of a difference. But the difference is so huge in bad times that is why it is absolutely the right thing to do. And I think that's the important thing to appreciate, particularly at the moment for companies setting up, because of course at the moment, companies are setting up with such huge risk across the board, the potential for failure is massive. So we must make sure we've considered this particular issue. As I said at the start, two questions there, which the fundamental answer is relatively straightforward, but some of the other issues around it could be hugely important. Do join us in a month's time when we will have a look at another two questions from the pages of Any Answers Answered. But for this month,